Good morning, ladies and gentlemen, boys and girls, and children of all ages, however you may be catching this. Today, I'm going to do a very good episode. Today, we're going to talk about how to look up companies' debt and also how to use some of the debt ratios and why is debt, looking up a debt on the company is very important. Making this episode, I know I talked about this before in the past, but I wanted to kind of centralize in on this. I usually ask questions on my platforms, whether it's my YouTube, Facebook, Instagram. I think I got about 3 Facebook pages. My Facebook pages are Prince Dykes MBA, the Investor Show, Royal Financial Investment Group, and also, here on YouTube where it's just the Investor Show as well. So while I'm making this is to say how to look up a company's debt. We're going to talk about how to look up a company's debt. Why is a company's debt important to investors? We're going to get into debt ratios, and we're also going to speak into how to compare the two as well, and why they're important, how to look them up. So the first thing we're going to get into is why is a company debt is important to investors. As an investor, you are an investor. If you're buying a stock, if you're buying a piece of real estate, a small business, or anything, a company's debt is very, very important. Why is a company debt very important? Because in the future, these are things that the company has to pay out. So you as an investor, you're putting money in today, or you're buying a stock today, or you're buying a piece of land today, based upon the money it can make in the future, right? You don't care about you care about what it's doing today, but you're looking at the future as an investor, right? If I buy a stock today, I want to know if it's going to produce money in the future. So when a company is making money, you're looking at how is it going to be able to pay me back? Who does it owe? Who do you owe? If you owe everybody in the world, then that limits the money of investors going to get back. But the less people that you owe, the more money that can come back into the company, build a company, more money for an investor like yourself. So this is why debt is very important. Another reason why is when hard times strikes, companies with a big pile of debt, they turn to debt management. They start to look at, oh, okay, for prime example, if I was to lose all my income today, I'm automatically going to stop all the things that I'm buying, right? I'm going to stop everything that I'm buying. I'm going to stop everything that I'm buying. I'm going to critique everything that's going out, and I'm going to be trying to stay alive. I'm going to be trying to survive. So in a downtime, companies with a lot of debt go into survival mode, right? Companies with little to no debt but have cash, when hard times hit, they go into thriving mode. So what I mean by that, take a company like Facebook who has little to no debt right now, little to no debt on hand, and they have a pile of cash. When the economy starts to decline, COVID-19, all of the good stuff come out, what people are automatically going to do, people are going to start to, those companies are going to look to buy up other companies, make acquisitions, expand, grow, all those things like that. So for prime example, let's take it to yourself personally. Let's say right now your business was not affected or your income was not affected by the pandemic that's going on. So if you was not affected, if your income wasn't affected by the pandemic at all, guess what? You're looking to expand. You're looking to buy a piece of real estate. You're looking to invest. You're looking to buy a stock. You're looking to expand your growth, right? Versus if you lost all your income, you're going to go into like debt management. Okay, who do I owe? Who can I pay tomorrow? Who can I push off to next week? What's important? What's not important? So this is why this is very important to an investor. How much baggage is the company carrying around, right? Now here's the big question everybody wants to know. Prince, you just told me why debt was important on the company. How do I look it up? So I asked this question just yesterday. I said, which company has zero debt? And the 3 options were Facebook, Google, and Apple. Facebook, Google, and Apple. Out of Facebook, Google, and Apple, which company has the most debt? Some people knew because they watched the show. Some people looked it up. Some people already knew, or whatever the case may be. But a lot of people just guessing. Apple, Google, Amazon. Like Amazon wasn't even an option. All three, two of them, one of them, right? And it was a guess. And there's nothing wrong with guessing. But the reason why I'm asking those questions is to make you become sharper as an investor. There was a time when I was investing and I didn't even know what financial statements were. I didn't know how to look them up. I didn't know how much money the company had. I would just read news articles, look at the price of the company, and look at the name of the company and say, oh, yeah, I heard this company's going to do some good things. I'm not ashamed to admit it. But as I grew and became better, now I rely on media outlets little to nothing. And one thing I always do on this platform, everybody know, I teach everybody how to fish. So I don't, rely on news outlets, even though they're great for certain things. I rely on them less and less because I know how to go get the information myself. I know how to go get the raw data myself. I know how to pull up financial statements. I know how to read through a financial statement. So I'm getting better and better and better at it. But I know how to pull them up, find out, okay, how much cash does this company have? How much debt does this company have? What's this company's net worth? What's the total asset to liability? Is this company profitable? Things like that. Now, I know how to pull it up myself, right? My mouth does get dry when I'm talking. So let's talk about how to do that. So first of all, you need to look at a company's statements. The company has three statements. Three statements. The first statement is debt, right? I'm not debt, not debt, but balance sheet, income statement, balance sheet, cash flow statement. Those are the three. Balance income statement, balance sheets, and your cash flow statement. So the statement we want to look at is the balance sheet. The balance sheet is going to have, it's going to tell us the money in the bank. It's going to tell us how many assets, how many liabilities, what's owed by the company, how much money the company makes, all that good stuff like that on a given day. A company reports its balance sheets, give all those statements out every 3 months. Once a quarter, and give out the annual report. So we're just finishing up quarter one, which was January, February, March. So now we're going to take how to look it up. So the number one way to look it up, let me share my screen here. Give me 1 second. All right, number one way to look it up right here, what you're seeing on my screen, is through the SEC. That's the number one way to look it up. The SEC is going to show you the SEC website. This is the United States Security and Exchange Commission. They was established in 1934 after, and guess what happened in 1929? And you can guess why it was established in 1934. 1929 was the worst stock market crash of all times. So now you're looking at 1934, right? You're looking at 1934. That's when they established the SEC, the Securities and Exchange Commission, to oversee publicly traded companies, publicly traded stocks. Now, so this is what, if you're a publicly traded company, if you take money from the public, meaning sell a stock, you have to abide by the governing body of the SEC. So they have to report to the SEC every quarter their financial reports, every year their financial reports, any major incidents that happen in their company, the CEO steps down, voting, all type of stuff. Anything that goes out into the public, this is where it goes to the SEC. This is where all your media outlets, the majority of your media outlets, get their information. When it hits here, when Berkshire Hathaway sells their company or whatever the case may be, this is where they look it up at. They get it on the 13F. Company got a major announcement, they put it on the 8K. Company has a quarterly report, 10K. Annual report, no, quarterly report, 10Q. Annual report, 10K. So right here, you go to the SEC website, and up under the SEC website, you can search for whatever company you're looking for, right? Whether you can go to latest filings or whatnot. Right here, I have a company pulled up called the Republic Service. It's a company that I'm kind of looking into, a waste management company. So let's say if I want to know how much debt this company has, I'm looking at it I can go right here to their debt. Boom. This is a pour out of all of their debt as of March 31st of 2020. So this is in millions. So they owe $8.9 billion in long-term debt. Now, right here, this is looking at the SEC filings. I do a company search. I type in whatever company. I'm looking at the interactive financial statement, but this is how you look at it on a dry financial statement. What I mean by dry, this is what the company turns in to the people. This is a 10Q. You're going to stroll all the way down, right? You're going to go to your assets. You're going to go to your liabilities. Up under your liabilities, where we at here, got your current liability right here, long-term debt or whatever, 8.9. So you can see it right here. This is what the company is telling the SEC what they owe in debt as of March 31st, 2020. So I can look at that and find a company's debt immediately, right? And then they will elaborate on their debt a little bit further, as you go down. You can elaborate on where the debt is coming from, all of the good stuff like that. Now, that is great. Okay, Prince, that company owes 8.9 billion. What does that mean? So what I do is whenever I look at a stock, I got to compare them. I have to compare. Certain companies have certain debts depending on what industry they're in. Like someone who may be in the technology industry, it may be customary to carry a lot of debt versus someone who may be in the soda industry or drink industry, right? So what I like to do is compare the top boys to themselves. If I'm looking at Coca-Cola, I want to compare you to Pepsi. If I'm looking at airline stocks, I go to the top three airline companies, Southwest and Delta. How much debt does Southwest carry? How much debt does Delta carry? Is this a customary thing? That's how I look at it. So now I say, well, who's the top competitor to Republic Services? Republic Services' top competitor is probably Waste Management. Republic Services number two. Waste Management is number one due to revenue, market cap, or whatever the case may be. So now let's see what Waste Management has compared to what Republic Services have. Now, this is so that's how you can look up a particular company, right? That's how you can look up a company's debt. Now, the next thing you gotta jump into, you gotta go into debt ratios. So now I just showed you how to look up the company's debt. Now you got to do ratios. Why ratios are important? Ratios are very important because how can you compare one company to another? For prime example, let's take which two companies I just did, Uber and Lyft, right? You take Uber and Lyft. Uber, you know what? Actually, I got it from here. This was a show that I did yesterday. Uber has total assets of $30 billion. Lyft has total assets of $5.5 billion. When we go to long-term debt, Uber has $6 billion worth of debt versus Lyft has $82 million worth of debt. Now I can't just sit here and say, "Oh, Lyft only has $82 million worth of debt, but Uber has $6 billion. Oh, Lyft has less debt." Yes, Lyft has less debt, but it's also a smaller company. Like I just said, in total assets, Lyft only has 5.5 billion compared to Uber, who has 30 billion. So when you look at total assets, Uber is about 6 times bigger than Lyft, right? So how can I compare your debt to this person's debt? This was where ratios come involved, like percentages, right? Like if you got two people that says one person says I made $100 on stocks a day, and another person said, well, I made $1,000 on stocks a day. You're going to look at the person that made $1,000 and say, well, they had a better day, or they was a better investor. But if you couldn't find out that person A who made $100 started out with $10, and person B who made $1,000 started out with $200,000, you would change your perspective because you broke down the percentages. You'd be like, oh, so if he started out with $10 and, or let's say if he started out with $100 and he made $100, he had 100% return on investment, right? Versus the person who started with $100,000 and made $1,000, like, oh, that person only made 1%. So you break it down to the percentages, you'd be like, well, person B, even though they made way more money, but due to the money they already had, they only made a 1% return on the investment. At the same time, this person made 100% return on investment. So it changes everything, right? So that's what you have with your debt. That's why you have to use debt ratios. And a couple of debt ratios I want to give you, you can use the debt to equity ratio to see how much of a company, you take their total liabilities of a company, which you get right off the balance sheet that I just showed you, take the total liabilities and you divide it by shareholders' equity. The shareholders' equity is the network, right? So by doing that, using it, because I want to see how much money you have in equity, and equity, the shareholders' equity is pretty much the network of the company compared to total liabilities. This is going to give me an idea of how much of your growth is funded by debt. Now you got the debt ratio. The debt ratio, you take the total assets divided by the total assets divided by the total liabilities, right? So you do that on both companies. Another one is you look at a company's net income. What is the company's net income? How much debt do they have? So if they have a net income of $10, if they take those $10, if they have a net income of $10, but they have a debt of $1 or whatnot, using that net income times 3, can they pay off their debt? Can they use their net income for the next 2 to 3 years to pay off their debt? That's another ratio that people look at. So no matter the size of the company, these are ratios that you have to use to compare one to another. You're like, okay, well, this company has so much debt, but due to its large income, it can pay off its debt with its net income within 1 year or 2 years. So its debt management is not that bad. Versus another company who maybe have a less way less in debt, but they don't make that much money, right? So this is why you have to use debt ratios. So there are plenty of debt ratios that you use. There's so many different financial ratios you can use, but I wanted to give you three to kind of help you look out for that. So that's going to conclude this particular episode. For the people who may be catching in late, we talked about why debt was important to investors. We talked about how to look up the debt with the companies, how to find a debt of any publicly traded company. And we talked about the debt ratios to use to compare one company to another, right? So I hope you got that. Don't forget to hit that like, subscribe, comment, and share button. And until the next video, podcast, cartoon, or whatever else crazy you see me do around the globe, peace, be safe. I'm out. Thank you.